Okay, so I wanted just to recap a little bit on what we talked about last time. We talked about wanting to get higher returns on the long-term money. Some of your most important goals were setting up an emergency fund, getting out of debt, and then really the biggest goal was building wealth for retirement. Is that still right? Okay. And we talked about getting high returns, minimizing the risk, and then also reducing the taxation. You said out of your $1,500 discretionary income that you had extra, that you would feel comfortable saving about $800 a month. Is that still correct? Okay, perfect. So of the $800, typically we're going to put some towards short term, some towards mid term, some towards long term. Kind of think about it as three buckets, right? You're going to put some towards your short term bucket, some towards your mid term bucket, and some towards your long term bucket. Your short term category, things like your emergency fund, your debt, getting out of debt, and then the last one was also you didn't have enough insurance having the little kids. So that kind of falls in the short term category too, just in case something were to happen to you as the breadwinner, making sure your family's taken care of. You didn't have too many midterm, so I'm gonna kind of leave that one out for now. But midterm could be if other goals come up, like you want to buy a home, a rental property, maybe start a business, pay for a kid's wedding. Those type of things can fall in that category. And then your long term goal was to build wealth, and your FIN number is, and you give them their FIN number. Okay. Um, you can also make the recommendation of how much they need to save a month to meet that FIN number there. Okay. So does all that sound good to you? Okay. So of your 800, and here's where you're going to make your recommendation. Every family is different. But I may say, I'm going to take $300 of it and put it towards the short term, and $500 of it and put it into the long term. So whatever your recommendation is right there, you're going to make that recommendation. And then you're going to ask them, does that sound right to you? Always get confirmation at every step here. Does that sound right to you? They say yes. Okay, great. So let's just really talk about the long term real quick. Oh, by the way, you know how you had that old 401k that was just sitting that you lost money in? There's something wonderful that we can talk about in a little bit, that we can move that 401k over. And it's going to be protected again with the floor that you can't lose money. And it's going to be diversified really well. So we're going to talk about that one. That's kind of a no-brainer. We can move it to a new account that you won't have to pay taxes on the move. But we'll talk about that in a little bit. Let's talk about this long-term money. Okay. You would also make any recommendations right here about what you're going to do to get out of debt sooner, and also the face amount for the insurance. So I may say, so right now you only have $100,000 of term insurance through work, but based on your income, your financial needs analysis said you need this much insurance. Maybe it's 850,000. Okay. Whatever that may be. Okay. Does that sound right to you? Again, yes. Okay. All right. Then before we go, really into what I'm suggesting for your long term, I just wanted to reaffirm with you what we talked about last time when we talked about there's different places to put your money. There's in fixed accounts, of course, there's in the market where you could lose, and then there's those index accounts that have the floor. For your long term money, which one of these would you feel most comfortable putting your money in? Okay, good. The fixed account. That's exactly what I had in mind too. And I feel is best for you based on everything we talked about. So let's talk about that long-term money real quick. The $500, the $300 is going to go to a short term. The $500, as far as where that's going to go, remember we talked about there's tax now, tax later, and tax exempt. We talked about how we obviously like tax exempt better. For the long-term money. Remember, tax now, bank accounts, checking accounts, those types of things. We're going to start you a tax now account for your emergency fund. And you make your recommendation on that. The tax later is that old 401k that we're going to roll. We can't move it into a tax exempt because that would trigger a taxable event. So we're going to move it like for like into a new IRA that is, and then you make your recommendation briefly, very, very briefly on that. Kind of very much assumptive close. You're going to go into details with that after you've closed the IUL. Okay, So let's talk about the tax exempt. There's only a couple things. There's Roth IRA, and then there's the IULs and the VULs. Now, again, if you're not securities licensed, you can't make recommendations on securities products. I am, so I may talk about these things. But I'll say the Roth IRA, great product. It's tax free when you take the money out. It does have limitations, though, based on your income and also based on how much you could put in. So, based on your goals of how much you want to put in plus your income, this typically isn't going to be the best thing for you and your family. Plus, there's that 59 and a half rule. And I know you mentioned that you wanted to have a little bit more access to this and not have to wait till you're 59 and a half. So the IULs, the variable universal life is variable. So again, could fluctuate with what the market does, or the index universal life has that floor. The other features on this is it also has living benefits. It also has life insurance built in. It's a wonderful product, but there is no 59 and a half rule. There's no income rule, and you're able to put a lot more money in than into the Roth IRA. But they are both wonderful products, okay? And you can decide which one you like. But let me show you, as far as the two of them, which one sounds best so far? Okay, the IUL. Well, let me show you how that works. So let's say you're putting in your $500 a month into your IUL. And now that stands for Index Universal Life. Index, of course, because it's hooked to an index, the savings portion is. Universal means flexible. And then life means that there's a life insurance death benefit as well. Okay. So you're putting this $500 a month in, and it goes into a cash value portion of the policy. Cash value is just a fancy word for savings account. The savings account is hooked to the index, and it just depends on the product, which index it is. Let's pretend it's an S&P 500 index, okay? Because that's one that most people are familiar with. So whatever that S&P 500 is doing, it's kind of mirroring that, okay? So when you put your $500 in every month, a little bit comes out and pays for your cost of insurance, okay? And so let's call that, $100 a month or something. Then that $100 that's going to its cost of insurance is buying you a death benefit, a face amount. And so you needed more coverage than that 100,000. So let's say the new face amount, these are just hypothetical, so you can understand the concept here of how this thing works. But let's say it's a $500,000 death benefit. Okay, so you're putting your $500 a month in, a little bit is coming out every month, paying for your cost of insurance. Your savings is growing here according to the index. If the market does well, you can participate in that market increase. But if the market doesn't do well, there's a floor. Okay. And again, it depends on which IUL you have, but let's say this one has a 0.75 floor. So again, if the market does 20%, you get 20%. If the market does negative 20%, you get a positive 0.75. Now, some IULs have a cap, and they might cap you at like 13.75 or a certain participation of the market. The one that I love right now, it's a great product. It does not have a cap. So whatever the market does, you get to participate in that. And if the market goes down, you won't participate. So I love this product. Okay. So again, you're putting your money in, it's growing. There's the floor. You cannot lose money, and it has the insurance. So now let's say you've saved, for 30 years, you're putting money in, you have your coverage, and then if God forbid, let's knock on some wood, if something happened to you and you died, your family would then get this plus whatever's in this cash value. And that goes income tax free in the form of a death benefit to your family. So that is awesome. But let's say you don't die, right? And let's say now you're 60 years old or 65 or whenever you wanted to access this money. By the way, there's no 59 and a half rule, but this is not an emergency fund. This is not to kind of put and take, this is a long-term thinking type of account. And I will show you some illustrations of how that looks. But let's say, you're 60 years old, you're taking this money out and you want to take the money out. Let's say you have a $500,000 in here. Again, if you died, your family would get this plus this. But let's say you have that $500,000 and you want to take some money out. Well, the money that you put in, the $500, let's say you did that for 30 years. So 500 times 12 times 30, you put in $180,000, and you have a $500,000. Well, the $180,000 was after tax money you put in, meaning you already paid taxes on it when you got paid. So that money can come out, obviously, income tax free. But what about the other hundreds of thousands of dollars that has accumulated? That if you were in a regular tax deferred account, you would be paying taxes on. Um, if you want to access that, instead of withdrawing from your cash value, instead, what we say is take a loan from the life insurance company. So let's say you want to take out $200,000 and you're going to go travel around the world, or I don't know, pay off your mortgage, whatever you want to do. Instead of withdrawing, you can take a loan from the life insurance company. So let's say they give you a loan at 3%. Is 3% better than 30% or whatever your tax bracket may have been? Of course it is. But what happens is they'll pull the 200,000 from the cash value and put it in a separate account that earns 3%. And again, it depends on the loan. It could be a preferred loan that's a wash loan, 0%. If they're paying you 3% and they're charging you 3%, how much are you really paying on that loan? But it could be, depending on when you take it out, it could be, you know, a tiny percent, okay, that you're paying on this loan. And again, we'll look at the exact policy that you're doing and when you're taking that money out. But this is how these things work. Instead of taking out, I'm going to erase this, but instead of taking out money from the cash value, you're taking out a loan from the insurance. Okay. And again, let's say you took that 200,000, you know, they paid you 3% and they charged you 3%. So you have that wash loan, and you have that 200,000. And let's say you took that loan. Now, remember, do you ever pay taxes on a loan? No. What do you pay? You just pay your interest. But when you buy a house and you get a mortgage, you don't get a big tax bill at the end of the year. There's no taxes. Okay. Now, if you were to die, they would just take, the money from that other account and just pay it off. You could pay it back. You could borrow this money from the insurance company to maybe pay off some debt, pay off, your mortgage, put your kid through college, pay for a wedding, and then pay the money back, of course, and continue to save. But you don't need to. As long as this policy is in force, there is no taxation on the cash value that's building up inside. There's no tax on the money that you're withdrawing, and there's no tax on the death benefit. Isn't that awesome? So now the other thing I would just tell you is there's so many other benefits. Now, there's a lot of names that people come up with that are just truly out of compliance for this product. The proper name is Index Universal Life, but it is referred to sometimes as the Swiss Army knife of financial services. And I love that because it does so many things. It's like that tool that does a lot of different things. It's tax deferred growth, right? Tax deferred growth on all your cash value that's in there. It's tax advantaged or tax exempt withdrawals, right? When you take the money out as a loan, you also have that life insurance benefit that your family needs. It also has a living benefit. So if something were to happen to you where you are, chronic or critical illness or some type of disability or something, there's riders that you can now have access to that $500,000 death benefit while you're alive. Now, the number one cause of bankruptcy in the United States is still medical bills. And so most people do not have a plan. If something were to happen to them, God forbid, they go to their next doctor appointment and they have a lump in their breast, or, they get in a car accident. So this is already built in. It also creates an immediate estate and estate preservation for you. It's able to transfer money to your beneficiaries, leaving an inheritance to your kids, income tax free. So it's just so many wonderful things. Plus, I think the big one here is that you cannot lose money. No loss, no losing money. Okay. So this is a wonderful product. Now, again, based on what your goals were on your financial needs analysis, I would say that we would put $500 into the IUL for now. And again, that would get you the proper coverage that you need. And then the other 300, we're going to be paying off the debt in that systematic way I told you, and funding that emergency fund. Once the debt's paid off and once the emergency fund is funded, then you can start overfunding and maxing out this policy. So how it works is you have a minimum that we suggest you pay, and you have a target, which we really honestly suggest you pay, and you have a max that you can put in. The max is a very important number. If you don't want to put more than you can, that more than that max number is, because then you might have taxable event. You want to make sure you don't max, put more than the max. Your minimum is kind of a guideline that says, hey, make sure you're always paying your minimum so your policy stays in force. And your target is kind of the goal that we want you to be paying over to properly fund this, at least for now. So right now, I wanted to make this policy very flexible for you and get you the proper coverage for your family and be on track to meet your goal, okay, and meet your FIN number. So we're going to start off with a little below your FIN number, but once the emergency fund is funded and the debt is paid off, then we can catch up over here, okay? So and you also have your other accounts, okay? So your minimum on this policy is $89.70 a month, okay? Your target is 211, and then your max that you can put in was $1,248. So based on what you wanted to save, which was $800 a month, right? You definitely are below your max, but it's also very much, very high over that target, which is where I want you to. If you can tell me, Jamie, yes, I can always pay that 200, then I will feel comfortable. Does that make sense? Okay, so how does that sound? So then the 500,000 death benefit does that sound right to you? Okay, good. And then starting off with the 500, does that sound right to you? Okay, perfect. So what we're going to do then next is fill out an application. So you have to fill out the application to make sure you qualify. Do you have any health issues? Do you have anything that would maybe like smoking or medications that you're on, hospitalizations, anything like that that I need to be aware of? Okay, then we'll start the application and we'll go through more questions on health and how risky you are if you're a race car driver, skydiver. We're going to go through all of that application and we'll submit it with your first month's premium, the $500. Then you cannot put any more money in until after you're approved. Okay, and that could take a couple days up to potentially a couple months. It usually doesn't take that long, but once you're approved, then you can start putting in more money. We'll start off with the 500, but you do have that flexibility. Okay, and again, we'll get you on that debt plan. We're going to now talk about, after we fill out this application, I'll kind of go over a little bit more about that rollover, which I'm really excited about for you. But I want to just get this little piece submitted because you have 2 little daughters, and I want to make sure that this is our priority of getting your family the proper protection that it needs. Does that sound good? All right, let's get started. Neil, I can't turn it off. Can't turn it off.
Rich is over there.
Okay, can you turn it off? Oh, there it goes. Wait, no, we gotta.